Okay, let's dive right into this fascinating Q3 2026 earnings report from Cogeco Communications. We are looking at what has to be one of the most compelling financial paradoxes we've seen all year. Seriously, it's a textbook example of why just glancing at headline numbers can be incredibly misleading.
To kick off our explainer today, we really need to tackle a seemingly impossible question, one that'll probably make you rethink how you analyze a corporate balance sheet. Think about it. How exactly does a company report a staggering $1.7 billion net loss for a single quarter, yet confidently raise its shareholder dividend and actually generate more free cash flow? Sounds crazy, right?
Well, to answer that, we're going straight to the source. This official news release from July 15, 2026 is going to ground our explainer today. It gives us the exact financial data and managerial commentary we need to untangle this massive financial knot. So here's our roadmap. We'll start with a tale of two markets, look at why Canadian operations are staying strong, examine the American competitive struggle, demystify that massive $2.2 billion impairment, check out their new brands and strategic pivots, and finally get to the bottom line.
Section 1. A Tale of Two Markets. Let's get right into it.
What's really interesting here is how this quarter sets up a sharp geographic divergence under one single corporate umbrella. On one side of the border, up north in Canada, we're seeing slow, steady growth, with revenue and adjusted EBITDA ticking upwards. But contrast that directly with what's happening south of the border in the American market, where those exact same metrics are experiencing double-digit declines. It's a real night and day situation.
Moving on to Section 2, Canadian operations stay strong.
Looking at our first geographic bucket, Canada is just delivering reliable, consistent results. Revenue grew 0.5% to $376.7 million. But what's even more impressive is that this marks their third consecutive quarter of positive adjusted EBITDA growth, climbing nearly 4% to reach $203.9 million. It's an absolute anchor of stability for them.
And look, this Canadian growth isn't just a happy accident. It's driven by the cumulative effect of locking in consistent high-speed internet additions over the past year. Plus, they are reaping major benefits from the successful full-scale launch of their wireless service, Cogeco Mobile. By bundling mobile with home internet, the whole fixed mobile convergence play, they're seeing a clear benefit in reducing churn. Simply put, fewer customers are leaving.
Now for Section 3, the American competitive struggle.
The story shifts pretty dramatically as we cross the border to analyze their American telecommunications segment. The numbers here are just stark. We're looking at parallel 10% declines across the board. Revenue dropped 10.1%, and adjusted EBITDA fell exactly 10.0%. That is a very significant contraction from the previous year.
So what's happening? Well, this drop is directly tied to a fiercely competitive U.S. market. You've got an aggressive pricing environment leading to a lower overall subscriber base compared to last year. On top of that, there's this growing shift toward internet-only subscriptions, and historically, those just carry lower overall revenue per user than the massive cable bundles of the past. All of these pressures are putting a serious squeeze on their top line in the States.
Which brings us to Section 4, demystifying the $2.2 billion impairment.
Yep, $2.2 billion. You read that correctly. This intense competitive pressure directly triggered the climax of this earnings report. During this quarter, Cogeco recognized a staggering $2.2 billion impairment charge on its U.S. operations. This single, massive line item is what dragged the entire company down to a consolidated $1.7 billion net loss for the period.
But hey, before you hit the panic button, let's talk about what a non-cash impairment charge actually is. It's essentially an accounting adjustment. It reduces the recorded value of an asset on the balance sheet because, well, market conditions have changed. The absolutely crucial phrase here is non-cash. This does not represent actual cash flying out of their reserves. It's a paper loss. It adjusts the valuation of their past American acquisitions based on current market realities, but it is not a sudden draining of the company's bank accounts.
If we drill down into that charge, the vast majority of it, $1.9 billion, is just a write-down of goodwill. And goodwill is purely an intangible accounting metric that pops up when you buy another company for more than its book value. Another $174.9 million was allocated to franchise rights and $127.6 million to property, plant, and equipment. So while it severely dings the optical net profit, their daily operational cash, totally untouched.
Let's look at Section 5, New Brands and Strategic Pivots. Management isn't just sitting around letting these U.S. hurdles run them over. To fight back against the subscriber losses, they've launched a brand new, highly digitized challenger brand called Welo. They originally tested it in Columbus, and now they've expanded Welo across their entire Ohio footprint. It operates right alongside their main BreezeLine brand to capture entirely different market segments, and it heavily accelerates the digitization of their sales and customer service.
And a CEO, Frederick Perron, highlights here, their strategy isn't just some marketing gimmick. It's about strict capital discipline. They are aggressively optimizing their capital investments as they head into the next fiscal year. Why? To ensure the underlying business stays highly liquid, nimble, and most importantly, capable of churning out cash.
Which leads us perfectly to Section 6, the bottom line.
Let's tie all of this together by following the golden rule of financial analysis. When the accounting gets overly complicated, just follow the cash. And here is the answer to the paradox we started with. Despite that massive on-paper net loss we just unpacked, their actual free cash flow jumped an impressive 17.6% to $169.2 million this quarter. That's up from $143.9 million a year ago.
This surge in real cash generation is being fueled by intense operational efficiencies and cost reduction initiatives from their 3-year transformation program. They've effectively managed their spending to completely offset the revenue drops. And this strong underlying cash health is exactly why the board confidently raised the quarterly dividend payout by 7%. They are rewarding shareholders with real cash because they see right past the optical accounting net loss.
So, Cogeco effectively presents us with an absolute masterclass in contrasting markets. They're strategically utilizing their solid, cash-generating Canadian stability, now bolstered by those new wireless offerings, to weather the fierce, impairment-triggering storms of the American landscape.
Which leaves us with one critical thought to take away from this explainer today. Will the strategic launch of their new digital challenger brand, Welo, finally be the thing that turns the tide and brings growth back to their U.S. footprint? Or will the intensely competitive American struggle continue to weigh down the consistent wins we are seeing up in Canada? We'll definitely be keeping an eye on it for the next quarter.